This week in economics on the second day of March 2014, as we roll merrily along in this particular month with perhaps wind behind our sail. We'll see how the sail is sailing. Nonetheless, the new chair of the Federal Reserve, Dr. Janet Yellen, testified before Congress, and many of the things she talked about we'll cover in this report. It is a mixed bag, I guess one would say, but we'll start out with Berkshire Hathaway. That is the company owned by one Warren Buffett of Omaha, Nebraska. They gave their annual report, and the whole argument here is, does Mr. Buffett still have it? Well, the answer to the question is yes. Their particular company is very large. They're in the reinsurance business, the insurance business through Geico and General Re there, and they're also in other things. Just mentioning a little bit of it, U.S. liability insurance is part of their insurance thing. Of course, the Burlington Northern Santa Fe, that is a rail conglomerate. They recently purchased Nevada Energy out in the Las Vegas area there. So they have a number of energy concerns, Mid-American Energy, Pacific Corp, Northern Power Grid, and several others there. And they also have something called Home Service, a very large real estate operation that he has under a ever-expanding umbrella of companies. And he has talked about, this is Mr. Buffett, bringing more companies under his umbrella. So thus, we look at it, we start in 1965, the relative results there was 13.8%. The S&P with dividends included was 10, and in per share book value was 23.8. This is 1965. We'll just move on down. Well, I guess we'll have to move on up. To get the rest of these, as flipped our page and flipped past. Nonetheless, in 2013, which is the year we'll look at, 18.2 and 32.4 and 14.2. So if you look at the annual compound annual gain, 1965 to 2013, 19.2% and 9.8% and 9.9%. And the overall gain was 693,500 and 5.89 percentage there. So thus the company rolls along here. And we'll attempt to roll along here also with some of the figures. Our point is not where it should be today. But nonetheless, with Hertz, the Berkshire now owns 8.5 companies that are fully standalone businesses. They would be Fortune 500, in the Fortune 500, only 491 0.1 to go, and we mentioned Nevada Energy purchase. That was $5.6 billion. That was by Ben America. They purchased it. It supplies 88% of the energy to the Nevada population. So he's went into things of this nature. It's been his strategy. Power that he called Mid-America is one of the Powerhouse Five, a collection of large non-insurance businesses. In aggregate, have a record of $10.8 billion of pre-tax earning in 2013, up $758 million from 2012. The other companies in this Sainted group are the Burlington Northern and Miramon there. If the U.S. economy continues to improve in 2014, we can expect earnings in our Powerhouse 5 to improve perhaps by $1 billion or so pre-tax. Of a dozen small non-insurance businesses earned $4.7 million pre-tax last year, up from 3.9 billion. That's billion. I'm sorry. In 2012, here too we expect further gains in 2014. Birch's extensive insurance business again operates as an underwriting profit in 2013. That makes 11 years in a row and increases its float during the 11-year stretch. Our float, money that does not belong to us, but we can invest in for Birch's benefits, has grown from 41 billion to 77 billion. This is what insurance companies do. They take in premiums and invest it. Concurrently, our underwriting profit has aggregated 22 billion pre-tax, including 3 billion realized in 2013, and all this began with the purchase in 1967 of National Identity for 8.6 million. Indemnity, I'm sorry. We now own a wide range of exceptional insurance companies, better known as Glico. You've seen that thing, the car insurance company. They acquired year-end in a full year-end 1995, and having for many years prior owned a partial interest in Glico. There's a little commercial that you see sometime there. You can do us a favor by calling 1-800-847-7536 or checking at Glico.com. He's always advertising. Again, that's 1-800-847-7536. We'll have to tell him we did a free commercial for him. Well, Charlie and Charlie is his 90-year-old partner, and I search for elephants. Our many subsidiaries are regularly making bold-on acquisitions. Last year we contracted for 25 of these, scheduled to cost $3.1 billion in aggregate. These transactions range from $1.9 million to $1.1 billion in size. Charlie and I have incurred these details. They deploy capital in activities that fit our existing business. Last year we invested $3.5 million in surely sort of bolt-on purchases. He talks about this Marmon here. Our purchase brought us to 100% ownership. That's MARMON. The purchases added about $300 million pre-tax to our current earning power, and also delivered us $800 million of cash. So evidently a very good purchase there. And we'll have to skip down. This is a very long report. It's 140-something pages. We obviously will not attempt to go through that, but we thought we'd touch on it a little better than some other things going on here. 4 companies present excellent businesses and are run by managers who are both talented and stockholders. At Berkshire, we much prefer owning non-controlling but substantial portions of a wonderful company to own 100% of a so-called business. So the big 4 earning there, he talks about that throughout his report. And our flexible in capital allocation, flexibility, our willingness to invest large sums passively in non-controlling businesses give us significant advantage over companies that limit themselves to acquisitions they can operate. Willie Allen stated the general idea when he said the advantage of being a bisexual is that it doubles your opportunity for a date on Saturday night. Similarly, our appetite for either operating businesses or passive investments double our chance in finding suitable uses for our endless gush of cash. In late 2009, in the midst of the Great Recession, we call it Depression, they bought the Burlington Northern, Santa Fe. And now they are literally transporting tons of petroleum product out there, and more money to them. Since 1970, our per share investment has increased at a rate of 19.3 compound annually, and our earnings figure has grown at 20.6 clip. And it is no coincidence that the price of Berkshire stock over 43 years period has increased at a rate very similar to that of our two measured values. Charlie and I like to see gains in both sectors. So here's up to date two quantitative factors. In 2013, our per share investment increased 13.6 to $129,253. Our pre-tax earnings from businesses other than insurance investments increased 12.8% to $9,116 per share. How would you like to have that? So this just shows some of what a basic investment company is able to do, like Berkshire Hathaway out there by these 80-year-olds. Mr. Buffett is 83. Of course, Munger is 90. That's about as old as one could get to be and still be out there. Let's see. There's one other quote we wanted to grab. I'm not sure it will find it here. Our pointer is not pointing as well today as we would anticipate. We won't go to the underwriting floats. We've already went through that. A very long summary here in the report. And we would advise you to go and see. Manufacturing services and retailing operations. We see that store, Warren says, pointing at the Nebraska Furniture Mart. That is a good business. Why don't you buy it? I said. It's privately held. Warren said. Oh, I said. I might buy it anyway, Warren said, and someday. That's Super Money by somebody named Adam Smith. I heard that character before. So they bought many, many things. Now, this home services they have, before we leave this as it is, has 22,000 agencies listed geographically, up 38% from 2012. Home services own Prudential, real-life living franchise operations, which are in the process of rebranding their franchise as Berkshire Hathaway Home Services. If you haven't yet, many of you will soon see our name on for sale signs. Buffett is one of these guys, he's constantly promoting and selling from his Dairy Queen to other items. A very interesting person to talk to, and a very easy person also to talk to. He's a fellow where you'd think he was an everyday Joe if you found him in his supermarket. Anyway, we'll do it for the Berkshire Hathaway Enterprise and move on here to bigger and better things. Maybe. Revisions to, this is the Congressional Budget Office. Projection of potential output since 2007. We won't go through all of that, but we've talked before how the CBC, how does the CBC use estimates of potential output? And just briefly kind of go over this. Use potential of output to guide its projection of actual output. The CBP's projection of economic activity in the later years of the standard 10-year projection period are based not upon forecasts of cyclical fluctuations, but in the economy, but of assumptions that actual output will gradually approach potential output. For example, the Budget and Economic Outlook 2014-2024, you heard about that, projects that actual economic output will remain at its historical relationship with potential output in 2007 and later years, because the central role of that projection or potential output plays in forming the baseline projection of economic activity and income. Projections of potential output also plays a critical role in CBC's baseline projection of federal spending. How does the Budget Office estimate potential output? It makes estimates of potential output on the basis of data, capital, labor, productivity, and actual GMP, statistical and other modeling methods for assessing cyclical influences and long-term trends in the economy, and analysis of the economic effects of the federal tax and spending policy. In general, CBC projections for 10-year periods are based on its estimate of economic trends during the most recent full business cycle and as of yet incomplete current business cycle. CBC's projections also incorporate predictions on the effects of federal tax and spending policies embodied in current law. That's the one thing to remember. It has to be in current law. It can't be something that Paul Ryan has dreamed up in his basement. To assess the role of current recent recession in these revisions, this report focuses on changes between the projections that CBC published in 2007 and in February of 2014 for 17. The latest projections have in common from the early projections to the latter one. CBC reduced by 7.3% the amount it projected for potential GMP in 2017. That calculation excluded changes in CBC's projections that arise from recent revisions, and we'll get to that. And for full sources account for 7.3% reduction in CBC's judgment of its projection potentials for GDP in 2017. The impact of cyclical weakness in the economy accounts for 1.8%, or about one-fourth of the difference from the 2007 projection, even though the downward revision to potential GDP coincides with the severe recession depression of 2007-2009. We play a little bit on semantics here. The reassessment of economic trends that were in the process before the recession began accounts for 4.8% percentage points, or two-thirds of the revision. For example, the National Bureau of Economic Research designated the fourth quarter of 2007 as the business cycle peak. The CBC concluded that the trend rates of growth in the 2000s had generally been lower than they were in the 90s, which is actually true. Revisions to historical data of that period before the recent recession lowered the projection of potential output by 0.1%, a very small revision there. The effects of change in federal tax and spending, higher federal deficits, change in the relative size of various sectors of the economy, and other factors after 2007, apart from cyclical conditions, account for the remaining 0.7% reduction, or about 1/10 of the revision. Now, this gives what the divisions are. Contributions to revision of the Congressional Budget Office projections between 2007 and 2014. Potential labor hours, 0.7%. Reassessment trend was at a negative. These are all at negative. 3 are there, and revision to pre-recession data at negative 0.3. The fiscal policy and other factors at 1.2, and all sources at a negative 2.7. And we'll kind of skip over those. We could get into capital services at a negative 0.6, and the reassessment that was at a negative 0.7, and revision to the pre-recession data was at, 0.2. This is in capital services. And finally, fiscal policy amounted to 1.3 in the negative, and from all sources, 2.4 in the negative. So perhaps you've figured out a little bit about what they're up to. But basically, leaving it to the models to plot where they are going. And let's see if we can get our pointer back again here. Nonetheless, did the question they asked here, did the Congressional Budget Office account for revisions to national income? Things are just jumping around here. To national income and product accounts. The current projection incorporates data from the product accounts released by the Bureau of Economic Analysis. This is in July of 2013. That revision expanded the definition of GDP, raising its value relative to those used in 2007. The most notable change was in measurement of investment, which includes new categories of intellectual property. That's moving into the 21st century, an expansion set of ownership transfer costs for home purchases. Overall, the Bureau of Economic Analysis raised its estimate of normal GNP each year between 1950 and 2012, an average of about 3.2%. In addition, the revised change there reference for prices and real output now report prices each year relative to prices in 2009 to account for the revisions to the measurement of real output and to facilitate the comparison between its current and previous estimates of potential output. The CBC adjusted its early projections, presenting the analysis in two ways. First, to account roughly for the change in the definition of GNP and to put GNP in the previous and latter projections on a consistent basis. Adjusted its previous projections of a normal output upward by about 3.2% for all years. Second, adjusted the reference year for the calculation of inflation and adjusted value in its previous projection to 2009, so that earlier projections of real output as present here and now we've got to $2009. We used to do this in $1970, so we've continued to move on. But let's move to the Bureau of Economic Analysis here. The real domestic product, that's the output of goods and services. You've heard that before. Increased an annual rate of 2.4% in the fourth quarter, 2013. That is from the third quarter to fourth quarter, according to the second estimate, and they do more than one estimate. In the third quarter, real GNP increased 4.1%. The GNP estimates released today are based upon more complete source data than were available in the advanced one last month. So the advanced one was last month. The advanced estimate, the increase in real GNP was 3.2%. In other words, it was revised downward. Was smaller than previously. Increase in personal consumption expenditures was smaller. That's PCE for those wanting to know. The real increase in increase in real GNP fourth quarter primarily reflects positive contributions from exports, non-residential fixed investments, and private inventory investments that were partially offset by negative contributions from the federal government. We go back to what role the Fed government has played in this. Residential fixed investment and state and local government spending went down. Imports, which are subtracted from the calculation of GDP, increased. The deceleration in real GNP in the fourth quarter reflects a deceleration in private inventory investment, a large decrease in federal government spending, and downturn in residential fixed investments. I think we've talked about this a bit. This is released on the 28th, so this is new information out here that we have not previously had available to work with. We like to get new numbers. The numbers, incidentally, I think we've been talking about this, are getting much better. Current dollar GNP, the market value of the nation's outputs of goods and services increased 4%, or 167.8 billion, and current dollar GNP increased 6.2%, or 251.9 billion. That was in the third quarter. Now, revisions, the second estimate, the fourth quarter percentage change in real GNP is 0.8%, or 32.7 billion, less than the advance. The advance is the first estimate. Primarily reflects a downward revision in personal consumption expenditure. We talked about that. Some of this begins to be a little bit repetitious, but we're reading from it. Many times what you hear is the press report, which tends to put things in. But nonetheless, the gross national product, domestic purchases, which measure prices paid by U.S. residents, increased 1.5% in the fourth quarter. 0.3% more than in the advance estimate. So in other words, people bought more. Excluding food and energy, the price index for the gross domestic purchases increased 1.8% in Q4 compared with an increase of 1.5% in Q3. Personal consumption expenditures increased 2.6% in Q4 compared with 2% in Q3. Durable good increased 2.5% compared with 7.9%. Non-durable increased 0.5% compared with 2.9%. Services increased 2.2% compared with 0.7%. Non-residential fixed investment increased 7.3% in Q4 compared with an increase of 4.8% in Q3. Non-residential structural increased 0.2% compared with 13.4% in Q4. Equipment increased 10.6%. That's a good sign. Compared with 0.2%. Intellectual property, we just talked about that, including inclusion. 8% compared with. Let's see, we're jumping around here and lost our intellectual properties. Well, we'll get back to you. Nonetheless, we got fixed. Okay. With 5.8% there. Real residential fixed investment decreased 8.7% in contrast to an increase of 10.3% in Q3. Real exports of goods and services increased, and this is a good sign, 9.4% in Q4 compared with 3.9% in Q3. Real export of goods and services increased 1.5% compared with 2.4%. Real federal, and we look at this very closely, government consumption expenditures and gross investment decreased 12.8% in Q4 compared with a decrease of just 1.5% in Q3. National defense decreased by 14% compared with a decrease of 0.5 tenths in Q3. Non-defense decreased by 10.1 compared with 3.1. In other words, the fourth quarter was much so severe. Real state and local government consumption expenditures and gross investment decreased by 0.5% in contrast to 1.7 tenths. That would be Q3. Change in real private investments added 0.14% to the fourth quarter. Change in real GMP added 1.67% to the third quarter change. Private business increased inventory to $117.4 billion in Q4, following an increase of $115.7 billion in Q3, and in Q2, $56.6 billion. Real final sales, domestic product, that's GMP, less change in private investment, increased 2.3 in Q4 compared with 2.5 in Q3. Real gross domestic purchases by U.S. residents and services increased to 1.4 in Q3, so it was down some. Current GMP dollars, let me see where we are here, increased 4% or $167.8 billion. We talked about this before. And we also talked about the revisions here, and we won't linger on those. Current dollar investments increased 3.4%, or $552.9 billion in 2013, at a level of $16,797.5 billion. That'd be 16 trillion. All right. Okay. Compared with an increase of 4.6%, or $710.8 billion. So you can see a little difference here in 16 trillion in that. During 2013, this is a measurement from the fourth quarter of 2012 to the fourth quarter there. Real GMP increased 2.5%. Real GMP increased 2% during 2012. The price index for gross domestic purchases increased 1.2 during 2013 compared with 1.5 during 12. So you see a little bit difference there as far as those particular numbers came in. So overall, the numbers are better for 2013. Mr. Buffett hands that out. And at the same time, he is optimistic in his sectors. One of the down and dirty situations that economists use is transport. Now, obviously, the Burlington Northern Santa Fe is doing a bang-buster business in transport. We haven't looked at UPS and those out there, but that's a little bit different. He's on the commercial side. He's ordering the petroleum produced in the Balkans primarily on to Louisiana and to put onto tankers. So that is an ever-increasing business. In fact, he's ordering 5,000, this is virtually half away, new tankers for their train setup. So in other words, jobs are being created by this enterprise, and the insurance business is doing pretty good. Now, that is in what we call the shadow economy. They're doing well. I heard from another lady was in the annuities game and several other things. They were hiring like gangbusters there, people placing their money in different categories. So in other words, we have not only anecdotal information coming in here, but we have actual information coming in. And let me just grab one other thing while we got here. The drought in California in terms of how it's affecting jobs here, that workers are being laid off. They make about $8.50 an hour in the San Joaquin Valley. Then it goes to the 2009 drought, one that was less extreme than this one. It caused job loss of $600,000, a $350 million loss in crops. But this one will be much more severe, according to the Pacific, the Business Forecasting Center at the University of Pacific in Stockton, California. But he said could see the 350 billion closer to closer to 1 billion, and 15,000 jobs. These are farm workers, and so the 6,000 before in the drought. So in other words, we're having climates affect many things that are going on throughout the U.S. You'll hear Chairman Yellen talk about what is actually going on in terms of the climate problems in the Northeast. So we have in the Northeast, we have in the West climate contributing, and we expect it to continue to contribute to economic costs in terms of dollar cost to GNP and impacting the labor market. This is one of the things she talks about. The Fed target is a mythical target, basically of 6.5% or 6%, and they will determine what they will do. In other words, does monetary kick in and deal with interest rates? If they remain at all-time low, that could damage the economy. But of course, when you raise interest rates, as Tom Volcker demonstrated, you make more people redundant or unemployed. So you don't want to do that at this point in time. But now the quantitative easing there has been a good thing for the market, not so good thing for Main Street. You'll hear that debated out, and they will continue to debate that. So that's basically her testimony has moved around that. The American bank Citigroup has lowered its expectation, has said that its 2013 net income would be reduced by $13.7 billion. That's 3.2 billion pounds. Said it believed fraud was an isolated incident. This is in Mexico, incidentally, there. So they're dealing with fraud in Mexico, and J.P. Morgan paid out $1.2 billion. So we are increasingly seeing problems with transparency in with the major banks. You'll hear a little bit when we do have that program about Sarbanes-Oxley, about the Dodd-Frank and how it's very important. Nonetheless, we'll do the numbers. The FTSE was down 0.57. These are Friday unless otherwise noted. The DAC in Frankfurt was up 103.75. In Paris, they were up 11.69. In Brussels, 23.30. In the negative. In Madrid, at 47.90. In Moscow, with the Soviet troops, Russian Federation troops on the move towards the Crimea, 3.99. They were down. In Johannesburg, they were up there in 2.79.31. In Bombay, 133.30. In Karachi, 304.355. In Lahore, in the negative, 12.75 on Friday. In Colombo, also 54.23 in the negative. And in Tehran on Wednesday, negative 301.90. In Sydney also, a part of the Asian contagion, 5.6 in the negative. In Tokyo, the Nikkei was also down 82.04. In Hong Kong, the Hang Seng, at 8.72. And in Shanghai, they were at 8.95. In New York, 49.06. The Nasdaq was down 10.81. And in Sao Paulo, 512.35 in the negative. And also in Mexico, 130.40 in the negative. We'll look closely at crude oil, Under the banner here, it was up 12 cents on the Brent crude future at 109.8, and the spot was up 18 cents at 108.9, and West Texas crude was up 24 cents at $102.53. T-Boone Pickens is jumping double somersaults, opened up a new ring for the circus, so to speak, there. Coffee futures were also up $1.05. Cocoa was up $2. Well, everybody was up. Cotton futures were down, and sugar was down. It should be down. Dubai Gold, our last item here, was down $5.90 at $1,322.07. Silver was also down. We don't usually give silver $21.07. It was down 11 cents. And that'll do it for us. Soybean futures up $20 and oat futures. Wait a minute. Soybean futures, it was up $20.75. And soybean oil was up 62 cents. Wheat futures were up $16.75. That's a bushel, or what do you want to call it there? And corn was up $9.50. The farmers made out like bandits, so to speak. Cocoa was up $11 there. So away we go, $1,839. That's for 1,000 pounds there. But this does it for the numbers, and this does it also for Numbers Man on the 2nd of March, 2014. And we will have a special segment. We'll talk about Janet Yellen because we're sort of limited here. But if you go to Spreaker, you can pick up her testimony. We're over there under This Week in Economics also. Have a good weekend and make next week a productive weekend for those in the business. And for the consumer, keep your eye on the ball as you've been doing there. And one little caveat here, during the deficit problems that the government-run debt, we want to talk about this. People can't talk about everything, I guess. People have anxiety, therefore they save more in anticipation of taxes and rough economic times to come.
Mr. Yellen, in your confirmation hearing, you commented on the need to monitor the costs and risks to financial stability that current monetary policy creates.
Chairman Johnson, Senator Crapo, and other members of the committee, I'm pleased to present the Federal Reserve's semi-annual monetary policy report to the Congress. In my remarks today, I will discuss the current economic situation and outlook before turning to monetary policy. I will conclude with an update on our continuing work on regulation. First, let me acknowledge the important contributions of Chairman Bernanke. His leadership helped make our economy and financial system stronger and ensured that the Federal Reserve is transparent and accountable. I pledge to continue that work. The economic recovery gained greater traction in the second half of last year. Real gross domestic product is currently estimated to have risen at 1.25 million jobs have been added to payrolls since the previous monetary policy report last July, and 3.25 million have been added since August 2012, the month before the Federal Reserve began a new round of asset purchases to add momentum to the recovery. The unemployment rate has fallen nearly a percentage point since the middle of last year, and 1.5 percentage points since the beginning of the current asset purchase program. Nevertheless, the recovery in the labor market is far from complete. The unemployment rate is still well above levels that the Federal Open Market Committee participants estimate is consistent with maximum sustainable employment. Those out of a job more than 6 months continue to make up an unusually large fraction of the unemployed. And the number of people who are working part-time but would prefer a full-time job remains very high. These observations underscore the importance of considering more than the unemployment rate when evaluating the condition of the U.S. labor market. Among major components of GDP, household and business spending growth stepped up during the second half of last year. Early in 2013, growth in consumer spending was restrained by changes in fiscal policy. As this restraint abated during the second half of the year, household spending accelerated, supported by job gains and by rising home values and equity prices. Similarly, growth in business investments started off slowly last year, but then picked up during the second half, reflecting improved sales prospects, greater confidence, and still favorable financing conditions. In contrast, the recovery in the housing sector slowed in the wake of last year's increase in mortgage rates. Inflation remained low as the economy picked up strength, with both the headline and core personal consumption expenditures, or PCE price indexes, rising only about 1% last year, well below the Federal Open Market Committee's 2% objective for inflation over the longer run. Some of the recent softness reflects factors that seem likely to prove transitory, including falling prices for crude oil and declines in non-oil import prices. My colleagues on the FOMC and I anticipate that economic activity and employment will expand at a moderate pace this year and next. The unemployment rate will continue to decline toward its longer-run sustainable level, and inflation will move back toward 2% over coming years. We have been watching closely the recent volatility in global financial markets. Our sense is that at this stage, these developments do not pose a substantial risk to the U.S. economic outlook. We will, of course, continue to monitor the situation. Mr. Chairman, let me add as an aside that since my appearance before the House Committee, a number of data releases have pointed to softer spending than many analysts had expected. Part of that softness may reflect adverse weather conditions, but at this point it's difficult to discern exactly how much. In the weeks and months ahead, my colleagues and I will be attentive to signals that indicate whether the recovery is progressing in line with our earlier expectations. Turning to monetary policy, let me emphasize that I expect a great deal of continuity in the FOMC's approach to monetary policy. I served on the committee as we formulated our current policy strategy, and I strongly support that strategy, which is designed to statutory mandate of maximum employment and price stability. Prior to the financial crisis, the FOMC carried out monetary policy by adjusting its target for the federal funds rate. With that rate near zero since late 2008, we have relied on two less traditional tools, asset purchases and forward guidance, to help the economy conditions support consumer spending, business investment, and housing construction, adding impetus to the recovery. And in September 2012, amid signs that the recovery was weakening and progress in the labor market had slowed, the committee said that it would continue the program until there was a substantial improvement in the outlook for the labor market in a context of price stability. In mid-2013, the committee indicated that if progress towards its objectives continued as expected, a moderation in the monthly pace of purchases would likely become appropriate later in the year. In December, the committee judged that the cumulative progress toward maximum employment and the improvement in the outlook for labor market conditions warranted a modest reduction in the pace of purchases, from $45 billion to $40 billion per month of longer-term Treasury securities, and from $40 billion to $35 billion per month of agency mortgage-backed securities. At its January meeting, the committee decided to make additional reductions of the same magnitude. If incoming information broadly supports the committee's expectation of ongoing improvement in labor market conditions and inflation moving back toward its longer-run objective, the committee will likely reduce the pace of asset purchases in further measured steps at future meetings. That said, purchases are not on a preset course, and the committee's decisions about their pace will remain contingent on its outlook for the labor market and inflation, as well as its assessment of the likely efficacy and costs of these purchases. The committee has emphasized that a highly accommodative policy will remain appropriate for a considerable time after asset purchases end. In addition, the committee has said since December 2012 that it expects the current low target range for the federal funds rate to be appropriate at least as long as the unemployment rate remains above 6.5%. Inflation is projected to be no more than half a percentage point above our 2% longer-run goal, and longer-term inflation expectations remain well anchored. Crossing one of these thresholds will not automatically prompt an increase in the federal funds rate, but will instead indicate only that for the committee to consider whether the broader economic outlook would justify such an increase. In December of last year, and again this January, the committee said that its current expectations, based on its assessment of a broad range of measures of labor market conditions, indicators of inflation pressures and inflation expectations, and readings on financial developments, is that it likely will be appropriate to maintain the current target range for the federal funds rate well past the time that the unemployment rate declines below 6.5%. Especially if projected inflation continues to run below the 2% goal. I am committed to achieving both parts of our dual mandate, helping the economy return to full employment and returning inflation to 2%, while ensuring that it does not run persistently above or below that level. I will finish with an update on progress on regulatory reforms and supervisory actions to strengthen the financial system. In October, the Federal Reserve Board proposed a rule to strengthen the liquidity positions of large and internationally active financial institutions. Together with other federal agencies, the board also issued a final rule implementing the Volcker Rule, which prohibits banking firms from engaging in short-term proprietary trading of certain financial instruments. In addition, we recently finalized the rules implementing enhanced prudential standards mandated by Section 165 of the Dodd-Frank Wall Street Reform and Consumer Protection Act. On the supervisory front, the next round of annual capital stress tests of the largest 30 bank holding companies is underway, and we expect to report results in March. Regulatory and supervisory actions, including those that are leading to substantial increases in capital and liquidity in the banking sector, are making our financial system more resilient. Still, important tasks lie ahead. We are working to finalize the proposed rule strengthening the leverage ratio standards for U.S.-based systemically important global banks. We expect to issue proposals for a risk-based capital surcharge for those banks, as well as for a long-term debt requirement to help ensure that these organizations can be resolved. In addition, we are working to advance proposals on margins for non-cleared derivatives consistent with the new global framework, and are evaluating possible measures to address financial stability risks associated with short-term wholesale funding. We will continue to monitor for emerging risks, including watching carefully to see if the regulatory reforms work as intended. Since the financial crisis and the depths of the recession, substantial progress has been made in restoring the economy to health and in strengthening the financial system. Still, there is more to do. Too many Americans remain unemployed, inflation remains below our longer-term objective, and the work of making the financial system more robust has not yet been completed. I look forward to working with my colleagues and many others to carry out the important mission you have given the Federal Reserve. Thank you. I'd be pleased to take your questions.
Thank you, Chair Yellen. As we begin questions, I will ask the clerk to put 5 minutes on the clock for each member. Chair Yellen, with inflation low and unemployment still high, does that give the Fed some room to continue promoting full employment?
Chairman Johnson, yes, it certainly does give us room to continue promoting full employment. And we have committed to do so and have made clear that we see an accommodative monetary policy as remaining appropriate for quite some time. There's no conflict at all at the moment between the two goals that Congress has assigned to us of promoting maximum employment and price stability. Inflation is running well below our 2% target, and as you indicated, that gives us ample scope to continue to try to promote a return to full employment, and we're committed to doing that.
Chair Yellen, what approach is the Fed taking with respect to insurance companies under the new rules implementing Section 165 of Dodd-Frank? How would the
companies with important involvement in insurance? We recognize that there are very significant differences between the business models of insurance companies and the banks that we supervise, and we are taking those differences and to attempt to craft a set of capital and liquidity requirements that will be appropriate to the business model of insurance companies. I would say, however, that the Collins Amendment does restrict what is possible for the Federal Reserve in designing an appropriate set of rules. So it does pose some constraints on what we can do, and we will do our very best to craft an appropriate set of rules subject to that constraint.
In what ways could the FSOC make the safety designation process more transparent?
So on this one, Senator, I would say that I think FSOC really has provided the public with a good deal of information about the criteria that it's using, the general criteria that it is established for attempting to determine whether or not an institution, an organization should be designated as a SIFI. And in the cases of those organizations where it has made a designation, it's really provided a wealth of information about those organizations. There are also opportunities for companies that want to contest designation to have an appeals process. So there is really a well-worked-out process. Now, as the FSOC goes on to consider other possible firms for designation, if it decides to use a different set of criteria, I think it's completely appropriate that the FSOC should also make clear if new criteria are being used to govern designations.
How has recovery impacted wages and income inequality? And if so, what can Congress do to address this major problem?
Well, Senator, I think the issues of income inequality, of rising income inequality in this country really date back many decades, probably to the mid-'80s, when we began to see a very substantial widening of wage gaps between more skilled and less skilled workers. And this is a trend that unfortunately has continued almost unabated for the last 30 years. Economists have debated exactly what the causes are, but technological change and globalization